In this second lecture on bonds, I'm going to talk about some of the details in terms of mathematics, and there's two particular topics which I've listed here. We're going to talk about similarity between bonds and balloon loans. We'll be able to use the balloon loan formula that we talked about in a previous lesson to do some analysis on bonds. And we'll also talk about creating a schedule for a bond. As I mentioned on the previous slide, some bonds are similar to balloon loans to the point where we can use the formula that we derive for balloon loans and apply it to bonds. So consider a bond that has the following characteristics: coupon rate J, face value F, and from that we can compute A, the coupon payment at every interval, a final payout, the redemption value B, a purchase price P, and the discount rate Y applied to all cash flows. This is the yield to maturity that we talked about in the previous lesson. And also N, that's the number of payment periods. So to determine the price of the bond, let's assume we don't know that. We don't know P, but we know all the other attributes here. We need to determine the present value at time of purchase for each interest payout and the final payout. So in other words, the present value of A as well as B. There's multiple of these A's, of course. This is the same problem as computing the principal for a balloon loan given the per period interest rate, payout per period, and balloon payout at the end of the loan. The only difference are the entities involved. In this case, with the bond, the entity providing the loan is the bond purchaser, and the entity taking the loan is the bond issuer. Simply restating the formula for the principal of a balloon loan, we have the following formula for the price of a bond. So we have Y, which is the YTM, N is the number of periods, A is the coupon payment, and B is the final redemption value. So this is exactly the same formula that we had for a balloon loan. Well, let's look at a little bit more detail into this on the next slide. I copied the equation from the previous slide at the top here. I just wanted to note that this first part of the right-hand side is the present value of the various payments, A, N of them. When you add them together, you get this equation. We went through the details of that when we computed this formula for the balloon loan. And then this expression here is the present value of B going back N periods. I had a couple of remarks also. The bond purchaser has sold the bond under the guarantee that the yield will be Y, and the purchase price P is computed under this assumption. The coupon rate is only used to compute the coupon payment A, and it's not the rate that's used here. The rate used is the YTM, yield to maturity, that's Y. It is assumed that the yield rate applies on the same schedule as the coupon schedule. If that's not the case, we need to do a conversion. We did that earlier, and I'll just mention it again here. If not, if these don't align, then the yield rate needs to be converted to an equivalent rate on the same schedule as the coupon rate using the conversion formula given here. So J would be the new yield rate using this formula, where the yield rate is compounded S times per year, and the coupon is distributed 2 times per year. So you need to plug that into this, and then you get your new yield. And then you would have both things on the same schedule in that case. Let's look at an example. Consider the scenario where a municipality wants to build $1 million school building. The head financial planner for the town wants to offer 5-year bonds at a semi-annual yield of 1.5%, with the coupon rate of 2%, paid semi-annually, and with the redemption value of $5,000, which is equal to the face value of the bond in this case. How many bonds does the municipality need to sell? So we have our coupon payment, that's the 0.02 times 5,000, so it's 100. And B is 5,000, the redemption value. Yield to maturity is 1.5%, and then there's semi-annual distributions over 5 years, so the N is 10. Then we use our formula from the previous slide, and we plug in our numbers here, and we find out the price would be 52.30.55, given this input. So we need to divide that number into a million to see how many bonds need to be sold to answer the question. We get 191.18, and so we need to round that up to the next number of bonds. So the municipality needs to sell at least 192 bonds to raise $1 million. So you may think it odd that from the very beginning, the yield and the coupon rate are different. So a couple of possibilities. One might be a timing delay. Maybe there was a challenge to the putting up this new school, and so there was a delay. And so in that case, the municipality issued bonds at 2% coupon when that matched market demand. However, if there was a delay before actual sale, the market yields, say they fell to 1.5%. The bonds now trade at a premium because their higher coupon is more attractive than the current market rate. So you notice this is 52.30. That's a premium over the original 5,000. But again, there was a delay. The market changed, and now they can get away with selling them at a higher price. Another possibility is the secondary market trading. Maybe a bank or an investment company bought a whole bunch of these bonds at first, and then the market changed as in this first possibility. So after issuance, the coupon remained fixed at 2%. That's always the case. But if market conditions shift and investors are willing to accept lower yields, 1.5%, existing bondholders can sell their bonds at premium to new buyers. This example illustrates how bond prices and yields adjust in secondary market trading based on changing market conditions. I have another example here. A purchase price other than the bond face value will lead to a different yield from the coupon rate, as we saw in the previous example. As a second example, consider a bond with the following characteristics. The redemption value is 1,000. The coupon is compounded semi-annually at a nominal rate of 6%, and the length of the bond is 5 years. Determine the purchase prices that will give yields of 4%, 6%, and 8% compounded semi-annually in each case. In all three cases, the semi-annual coupon, that doesn't change with the different yields here, that would be $30. You just need to divide the 6% by 2, change it to a decimal and multiply times 1,000. Then the coupon is 0.03. It's just this quantity here, the 0.06 divided by 2. And then, as we mentioned, there's 10 periods, 5 years, and semi-annual gives you 10 periods. So in the case of 6% yield, Y, the yield, the desired yield, and the coupon rate are the same. And so the price in that case should be set to the redemption value, which is $1,000. And in that case, the bond is said to be purchased or sold at par. Let's look at the other two cases of 4% and 8% yield on the next slide. In the case of 4% yield, we have Y equals 0.02. It should be emphasized that A doesn't change. I've mentioned that before. Then we use the balloon loan calculator to determine the purchase price. So I cut and pasted the interface here. So we're looking for how much to charge for the bond. So we'll leave that at 0. Then the semi-annual interest rate is 0.02, 10 payments. The balloon payment, which is the redemption value of the bond, is $1,000, and then it's $30. We computed that. That's the periodic payments, the coupon. So the terms are different, of course, but the balloon, as we mentioned, the balloon loan is similar to the bonds. We plug all that in to compute the purchase price, and we get $1,089.83. Then I just made a note here that bonds are typically listed per $100 of face value, so it would be advertised as this amount here. Then the same thing for an 8% yield. We need to compute the semi-annual yield, so 0.04, 10 payments. Again, the redemption is still $1,000. The coupon is 30. You plug all that in, and you get $918.89. So this is known as selling the bond at a discount, since it's less than the face value, and this is buying or selling the bond at a premium, since it's more than the face value. Extending the previous example, I have this chart here where we have several yields and the associated bond price. You notice that the bond price goes down as the yield goes up. So that's typical. You have this inverse relationship. And the idea is that you're holding a bond that pays out $1,000 at the end with this 3% semi-annual interest. And maybe the market has changed and someone can get 5% semi-annually for a similar term and payout. And so in order to match what's going on in the market, you need to sell your bond at a lower price in order so that the yield is matching the market of 5%. So that's the idea there. So let's look at a particular example. For example, assume AIM purchases a bond at 6%. So in other words, this one here, compounded semi-annually, face value of $1,000 in a term of 5 years. Abe decides to sell his bond in 2.5 years. Excluding brokerage fees, for how much should Abe expect to sell his bond? So first note that Abe is basically selling a 2.5-year bond at this point. We're assuming he got the first 5 coupon payments and there's 5 more to come, just to be clear. With the redemption value, it still is $1,000. And we need to compare this to other bonds with a 2.5-year term. Assume that such bonds now have an average coupon of 7% semi-annually compounded. Thus, the price estimate should be based on a bond with Y yield is 0.035. The coupon would be the same, $30, but the N is 5. So we can't use this table here because this was based on N equals 10, this 3.5%. Key here is A remains the same at $30. It's the initial issuer of the bond doesn't change the coupon even if it's resold. Using the balloon loan calculator, and I've shown that here, the output, we put in 0.035 for the interest rate. Total number of payments are 5. The balloon amount is still $1,000. The payments are 30. And you do the you leave this blank because you want to compute this actually, or leave it at 0. And then you get $977.42. Okay, and again, the difference, this is different from that number here because this was based on N equals 10, and as we noted, the Abe is selling it the bond was 2.5 years left, so we only had 5 semi-annual periods, thus the number 5 in here. On the following slide, I want to talk about a schedule for a bond. What I mean by that is if you purchase a bond, for example, at a premium, so you paid more for it than the face value, the redemption value, you have a loss at the very end when you redeem the bond. And then for tax purposes, you can, depending on where you're at, what government entity you're into, which state or country, you can declare that on your taxes as a loss for that year. But you may also want to break up that loss over the course of the bond's life. And that's what I'm going to talk about on the next slide. On this slide here, before we get to that, I want to talk about different ways of categorizing whether you've purchased a bond at a premium, at a discount, or at a loss. And to do that, I want to rewrite the equation a little bit for our bond. So we'll use this notation that I introduced, let me point to it, that I introduced earlier when we talked about annuities. And the reason I did this is we only need this here. We don't really need the details of this right now. So this is our formula for a bond, same as for a balloon loan. And we just plug this in here and here. And then with some rearrangement, we take the B onto this side, and then we factor out the A sub NY, and we get this expression here. And we can use this to make some statements concerning whether you've purchased the bond at a premium, a discount, or at par. So if P is greater than B, we know by definition that's purchasing a bond at a premium. But there's other ways of categorizing this. So first of all, just note that the premium is P minus B. So you've paid $1,100 for a bond that has a $1,000 face value. So the difference, $100, is the premium. It's basically a loss when you redeem the bond. The above formula also provides another way to categorize a premium bond purchase, i.e. when A minus YB is greater than 0. So if P is greater than B, this is greater than 0, and we know that this A sub NY is greater than 0, which means that this has to be greater than 0. A minus YB needs to be greater than 0. In other words, if the coupon A exceeds the periodic yield YB, then the bond is purchased at a premium. So that's yet another way of seeing that a bond has been purchased at a premium. Then we have a third way. If the redemption value equals the face value, which we've been assuming all along, then the coupon equals the coupon rate times the redemption value. And we can plug this into our equation here, or inequality here. And we get this plugged into here, and we get this here. And since B is greater than 0, and this whole expression is greater than 0, then J minus Y must be greater than 0. In other words, a bond is purchased at a premium if J, the coupon rate, is greater than the yield. And then the same analysis we can do for P less than B. That's when you purchased at a discount. Then A minus YB is less than 0. So the coupon is less than the periodic, is greater than the periodic, is less than the periodic yield, in this case. And the coupon rate is less than the yield. And that would tell you, any one of these three conditions would tell you that the bond has been purchased at a discount. And then if P equals B, that means you've purchased the bond at par. And in that case, A, the coupon, equals the periodic yield, and the coupon rate equals the yield. Okay, so that's quite a bit there. You may want to pause the video just to read through this a second time. But again, all I'm doing here is giving you three ways of categorizing whether you've purchased a bond at par, at a premium, or at a discount. What I want to do next is give you an example of when you purchased a bond at a premium as to how to distribute that loss over the course of the bond. And I actually have a calculator to do that. So first I'll show you the example, then I'll give you a little bit of a trial or a demonstration of the software that computes that for you. We now return to the accounting tax issue mentioned at the beginning of the previous slide. If a bond is purchased at a premium, the redemption amount is returned to the bondholder on the redemption date, and in effect the bondholder will incur a loss at that time. Depending on the applicable tax laws for the bondholder, there are at least two cases. The loss can be applied against the bondholder's income at the time of redemption, in other words, for that tax year, so you take the loss all at once. Alternately, and again this depends on the tax laws where you live, the bondholder could allocate, i.e. distribute the loss over each bond interest period over several tax years, with the exception of short-term bonds that do not span more than 1 year, in which case you're forced into the first case. So we'll look at an example of that in the next slide. So our example of a bond bought at a premium is as follows. We have a Ms. Ernestbuter who purchased a $100,000 bond where the redemption and the face value are the same, with a nominal annual coupon of 8% and a nominal annual yield of 6%, and the remaining duration of the bond is 10 years. So maybe it was a 15-year bond. She bought it 5 years into the bond's life. The market conditions changed, and so she had to pay a premium for it, and the yield was effectively 6% rather than what it started at as 8%. Now, remember, the coupon payments remain the same. It's just that this yield is based on the present value of all the coupon payments plus the price of the redemption payout at the very end. So we can calculate that, and using these numbers, we calculate the coupon rate, 0.04. We have to divide by 2. Yield is 0.03. Since J is greater than Y, we know it's bought at a premium. And if we use the bond schedule creator, which I'll show you, it's a Python program to do the calculations, you see that under these conditions, the purchase price would be $114,877.47. So basically, Ms. Ernstbuter has a $100,000 bond. She paid over $114,000 for it. She's going to make $4,000 a month. The coupon remains the same. It's still based on the 0.04 per period. However, when she redeems the bond, she's only going to get $100,000 back, so she's losing over almost $15,000. And that's why the yield is effectively 0.03 because of that loss. Now, what I'm going to show you on the next slide, and it's explained here, but I think it's better if I show you in the slide, with the table that's generated, is that she potentially has a choice, depending on tax laws and where she lives, of distributing that loss, the almost $15,000 loss. She can distribute that over the 10 years of the duration of the bond. Could be 11 years if the first semi-annual payment was like in the second half of a year, and then you would actually have you would cover 11 years in that case. But she can distribute the loss over the 10 or 11 years, or again, depending on tax laws, she could just take the almost $15,000 loss at the very end, that final year where the bond becomes over with. So I'll show you that on the next slide. So I have the table I mentioned on the previous slide here. It shows the periods on the left. As we noted, they could span over 10 or 11 years. Then we have the coupon. So this money is distributed to the bondholder regardless. That's something that you normally would need to pay taxes on. The wrinkle here is the loss, because the bond was bought at almost $115,000, and the redemption is only $100,000. So one simple option, if it's allowed by the tax laws where you live, would be that you take the loss at the very end and you subtract that from your earnings or capital gains or whatever, however the laws are structured where you are. So that's one option. That's kind of an easy option to deal with. It's just a loss from the purchase price. And the other option is that you distribute the loss over the 20 periods. And to do that, and I have the details here, but I'll explain it as let me point to things here. Sorry for not pointing. You take the book value to start, and you multiply this by 0.03. That's the yield, and you get this much money. So this is effectively what you're making in terms of interest. So you would pay tax on this, or equivalently, you would be declaring a loss of this much here. That's just this number from the 4,000. And then you would take this number, subtract it from the book value. You get this number, and you multiply this by 0.03. You get this number here. That's kind of your loss, or what you've made, not your loss, but how much you've effectively made in the second period. And you subtract this from 4,000. This is your loss in the second period. And then you subtract this number from here to get this updated book value, and you continue all the way down. So if you take this approach, you're distributing this almost $15,000 in loss across 20 periods, and at the same time you're amortizing your book value from the purchase price down to $100,000, which is what you actually get at the end. That's what I've described here in the note. Okay, so on the next slide, I'll show you the interface to the Python program that will generate tables like this. And I'll also make the program available to you. I'll give you the link in the description to this video. So this is the user interface to the program I mentioned. It's called Bond Schedule Creator, and it's pretty simple. You put in the redemption value, 100,000 in our case. The number of periods was 20 in our case, and then we had the coupon rate 0.04, the yield 0.03, and then you click this button, and it'll show you the schedule, which is what we were just looking at on the previous slide. It'll actually pop up on your screen, and you'll see this here. And the other thing it'll do is it'll send the output to a file, CSV file, on the same in the same directory where you've launched this this program from. So you have the option of opening the CSV file using, for example, Excel, and studying the result that way also. Okay, so that's a program I'll make available. And I'll make available both the Python program, and the Python program runs on a Jupyter Notebook. I know a lot of people use that, including myself. So it'll basically be two versions. And I'll give you the name of the files and the location on GitHub, so you can download those and play around with them. So I want to do one more example, very similar to this, in the next couple of slides. The difference is going to be that the bond is going to be purchased at a discount, and what will happen is you're going to get negative numbers here in your adjustment, so you're actually getting more money than your coupon. And again, based on tax laws, there might be more than one way of reporting that. I'm not a tax expert, so don't hold me to to anything I'm saying here in terms of how it may apply specifically to where you live. I'm just showing you the different options which may be possible depending on the tax laws in your locality. So in contrast to the previous example, we have a bond that's being purchased at discount. There's a Mr. Everest who buys a $50,000 bond. The term of the bond is 5 years. The coupon rate is 4% semi-annual, and the yield is 5% also semi-annual. So we can compute the coupon rate. That's J equals 0.04 divided by 2 because it's semi-annual. You get 0.02, and the yield Y we can compute. That's just 0.05 divided by 2, so we get 0.025, and number of periods is 10, 5 years, and compounding twice a year. So this may be another example of where the bond was bought on the secondary market, which explains why the coupon rate and the yield are different. Basically, the yield had to be adjusted to meet the market conditions. And since J is less than Y from our previous analysis, we conclude the bond has been purchased at a discount. And we'll see the actual purchase price implied by these input numbers here on the next slide. In fact, the table on the next slide is generated by the same bond schedule creator that I showed you and used in the previous example. The difference here is we're going to have negative adjustments rather than positive adjustments because of this being purchased at a discount. And in terms of tax purposes, and again, I'm not a tax expert, and this would vary based on where Mr. Everett is located as to whether he could actually do this, but potentially there's two options. One, he would pay tax on the realized gain, $21.88 in the final year of the bond's term, or distribute the gains over the life of the loan. We'll see that in the table. In either case, he needs to pay taxes on the coupon payments received each year. And I just mentioned here that showing the book value adjustments as negative in the following table seems odd to me, since the amounts are being listed as profits on one's tax return. I have a similar comment on the previous table. I guess the idea is for interest on book value plus the book value adjustment to equal the coupon. So I guess it's just the way things are in terms of accounting. It seems odd to me, and may to you also, but I'm just following what's typical. All right, so let's look at the table on the next slide. So here's the breakdown table for the particular bond in question. If you put in the $50,000 redemption value, 0.025 yield, and 0.02 coupon rate, then in order to meet those numbers, and given the term, of course, and period, semi-annual, you would have to buy the bond at this value here, 47,811.98, and that would generate the effective yield over the course of the bond. So that would take into account the coupon as well as the capital gain that you make from the purchase to the redemption value. Okay, so you pay taxes on the coupon regardless. That doesn't change. It's the same as if you bought it at a premium or if you bought it at par. This remains the same. What's different is when you do these calculations here, the interest on book value and the book value adjustment, those are different. You take the 0.025 times this, and you get this number here. When you subtract this from the coupon, you get a negative number, or to phrase it differently, when you add this negative number to this, you get the coupon. Then you do the same thing here. You add this now to this number, because you eventually want to get up to the 50,000. So you add this here, and then you take 0.025 times this, you get this number here, subtract it from this, and you get this negative number, and so on. And then basically you have two options. This, again, depending on how taxes are wherever you may live and what rules apply, but potentially there's two options. One, you claim these additional amounts over the course of the bond, so over the 5 or 6 years, in addition to the coupon. So basically you're paying tax on these numbers here. So you're distributing the capital gain between when you purchase the bond and the redemption value. So that's one option. The other option is when you add all these together, you get this 2188.02, which is the increment from the purchase price to the redemption value. And if that's allowed, you could potentially pay tax on that additional amount at the very end, as well as paying the taxes on the coupon along the way. Or you could distribute this over the term of the loan, term of the bond, and you would be paying taxes on all these, and then you wouldn't have this additional amount to pay taxes on at the end. Okay, so that was the final slide in this lesson. I have one more lesson on bonds, and then several lessons on capital budgeting, which I haven't done yet, but I'm planning those, and then several lessons on stocks and on derivatives, and then a large example that covers a lot of the different things that I've talked about in previous lessons. Okay, so if you like this, stay tuned, and please give it a thumbs up. Thank you.